Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're discussing a significant change in the mortgage landscape set to take place tomorrow. The Office of the Superintendent of Financial Institutions, or OSFI, announced that starting November 21st, 2024, the stress test requirement for switching lenders on uninsured mortgages will be removed. This change is expected to ease the process for borrowers wanting to switch lenders without increasing their loan amount, a process known as a straight switch. For those unfamiliar, a straight switch refers to transferring a mortgage from one lender to another without changing the loan amount. This typically involves uninsured mortgages, which are home loans that do not have mortgage default insurance, usually applying to loans with a down payment of 20% or more. Previously, borrowers had to prove they could afford payments based on a requalification at an interest rate 2 percentage points above their contract rate, which limited their options and negotiating power, especially if their financial situation had deteriorated. This move by OSFI is largely seen as a win for mortgage borrowers, offering them more flexibility to switch lenders in search of better rates or more favorable terms. It comes at a crucial time, with about 70% of all outstanding mortgages in Canada expected to come up for renewal by the end of 2026. Mortgage rates have been rising, and those originated between 2020 and 2022 could see payment increases of approximately 40%. As a result, competition among lenders is expected to intensify as they vie for new business and work to retain their existing clients. OSFI indicated that this change was driven by feedback from the industry regarding the imbalance between insured and uninsured mortgagors at renewal. Insured borrowers were not required to requalify at the stress test when switching, while uninsured borrowers were. OSFI noted that the prudential risks anticipated by this requirement had not significantly materialized. As a regulator, OSFI aims to enable banks and lenders to compete and take reasonable risks. Lenders have not received detailed guidance from OSFI beyond its public statements, but OSFI has scheduled calls with industry stakeholders and the media to discuss the new requirements. These discussions will include updates on the minimum qualifying rate and a revised regulatory notice on commercial real estate lending. For borrowers, the removal of the stress test requirement opens up new opportunities. Ron Butler of Butler Mortgage emphasized that this change makes securing a better rate at renewal more possible and is about fairness to borrowers. The old system was inconsistent, as borrowers who stayed with their existing lender did not undergo requalification checks, while those switching lenders had to complete the full underwriting process. Mortgage professionals. Canada President and CEO Lauren Vandenberg mentioned that this change allows homeowners to secure the best rate fitting their financial needs without unnecessary barriers, offering them greater choice and flexibility. On the lender side, the removal of the stress test on straight uninsured switches means lenders will need to be more competitive to retain existing clients who might be enticed by better offers from competitors. Devin Odrum, Vice President and National Director of TD's Broker Services, acknowledged this as a massive win for consumers, but also noted that significant outflows of clients are not expected as lenders work hard to retain them. Odrum pointed out that about 3/4 of outstanding loans are conventional or uninsured mortgages. These borrowers are typically less prone to financial stress and are less likely to switch lenders. However, lenders might need to sharpen their approach, especially those without deeper client relationships through multiple products. Katie Boschart, President and CEO of Manulife, emphasized that lenders would need to enhance customer service to retain clients who now have more freedom to shop around. Tracy Gomes, Senior Vice President of Real Estate Secured Lending at Scotiabank, noted that the change is beneficial for clients who previously felt trapped at their institution. First National CEO Jason Ellis suggested that media claims of borrowers being trapped due to the stress test were exaggerated. While he acknowledged the flexibility for borrowers, he did not foresee a dramatic shift in borrower behavior. He emphasized that lenders would go to great lengths to retain their borrowers. There's been speculation about whether OSFI might eliminate the stress test entirely. John Webster, former CEO of Scotia Mortgage Authority, predicts it could be phased out within the next year, particularly as OSFI introduces new loan-to-income limits for highly indebted borrowers in early 2025. However, not everyone shares this optimism, with some industry experts remaining skeptical. Today, we're diving into some regulatory actions taken by the Financial Services Regulatory Authority, or FSRA, against Canada Mortgage Group Incorporated, and two of its key figures, Raj Vikash, also known as Roger Kalwani, and Preeti Amin. This development is crucial for understanding how regulatory bodies are upholding standards within the mortgage industry in Ontario. The FSRA has imposed a compliance order and administrative penalties totaling $45,000 on Canada Mortgage Group Incorporated. Additionally, they have levied a $10,000 penalty on Raj Vikash Kalwani, the principal broker, and another $10,000 penalty on Preeti Amin. Furthermore, the FSRA has implemented specific license conditions on Canada Mortgage Group Incorporated to address the issues identified. These penalties stem from several contraventions of the Mortgage Brokerages, Lenders and Administrators Act 2006 and its accompanying regulations. The core of these violations involves the failure to take reasonable steps to ensure that the mortgages presented through Preeti Amin were suitable for two borrower clients. This is a breach of subsection 24, one of Ontario Regulation 188/08. Moreover, Canada Mortgage Group was found to have inadequately disclosed, in writing, the material risks associated with the mortgages they arranged for these clients. This lack of disclosure violates subsection 25(1) of Ontario Regulation 188/08. Transparency about risks is a critical component in the mortgage process, ensuring borrowers are fully informed before making commitments. In addition to the above, Canada Mortgage Group failed to adequately disclose conflicts of interest in writing to their borrower clients, contravening subsection 27(1) of Ontario Regulation 188/08. Disclosing conflicts of interest is essential in maintaining trust and integrity within the financial services industry. Preeti Amin was specifically cited for causing these contraventions under Section 3 of Ontario Regulation 187/08. This highlights the responsibility of individual brokers in ensuring compliance with the regulations and maintaining ethical standards in their practices. Raj Vikash Kalwani, as the principal broker, was also found to have failed in taking reasonable steps to ensure compliance with the Act by both Canada Mortgage Group and Preeti Amin. This failure is contrary to subsection 2(1) of Ontario Regulation 410/07. Principal brokers have a duty to oversee and ensure that their firms and employees adhere to all regulatory requirements. These enforcement measures were the result of a settlement between the FSRA, Canada Mortgage Group, Raj Vikash Kalwani, and Preeti Amin. Settlements like these often serve as a reminder of the importance of regulatory compliance and the consequences of failing to meet established standards. For those interested in further details, FSRA's enforcement database provides insights into how the authority is actively working to protect consumers through its monitoring and enforcement activities. This case underscores the FSRA's commitment to maintaining a fair and transparent mortgage market in Ontario. In a noteworthy development, Canadian households are showing a renewed interest in borrowing through home equity lines of credit, or HELOCs. Statistics. Canada data indicates that the balance of HELOC accounts climbed in September, marking a resurgence in this type of borrowing after a period of decline due to higher interest rates and stricter lending standards. This shift comes amid a backdrop of returning cheaper credit and a bullish outlook on real estate, prompting households to tap into their HELOCs at a pace nearly matching mortgage credit growth. The HELOC debt owed by Canadian households has reached its highest level in nearly 2 years, with balances increasing by 0.4% or $720 million to $170.8 billion in September. This represents a 3.0% increase compared to the previous year, bringing the balance to levels not seen since November 2022. The data highlights a notable uptick in HELOC activity, suggesting a growing comfort among Canadians to leverage their home equity for financial needs. The annual growth rate of HELOC debt has also seen a significant rise, reaching its highest point since October 2022. This comes after 4 consecutive months of acceleration, a stark contrast to the previous scarcity in annual growth. Over the past 5 years, only 16 months have shown positive annual growth in this sector, indicating a shift in borrowing behavior. Interestingly, Canadians have been opting for HELOC-like loans, which are structured differently than traditional HELOCs. These loans, categorized as non-mortgage consumer loans secured with residential real estate, have grown to an outstanding balance of $325.23 billion in September, up by 3.2% from the previous year. This growth is accelerating at a faster rate than strictly defined HELOC debt and does not include lending from non-federally regulated financial institutions, such as credit unions and private lenders. Rising interest rates initially helped to cool borrowing across various types of credit, including HELOCs. However, recent trends indicate a resurgence in HELOC borrowing, almost at par with residential mortgage growth. This uptick may lead to increased regulatory scrutiny in the coming months, as the borrowing patterns could have broader implications for the housing market and financial stability. Let's turn our attention to a topic that's been gaining traction in recent discussions: the potential for a housing crisis in Canada. With mortgage delinquency rates on the rise, particularly in major cities like Toronto and Vancouver, there's growing concern over what the future holds for the Canadian housing market. According to Mathieu Laberge, the Senior Vice President of Housing Economics and Insights at the Canada Mortgage and Housing Corporation, Vancouver is expected to see mortgage arrears double in the next year. Toronto is also experiencing a significant increase in delinquencies. While these rates are still low by historical standards, the trend is worth monitoring, especially in these high-cost markets. Laberge emphasizes that keeping a home is often a top priority for Canadians facing financial difficulties. This means they might delay payments on other credit types, such as car loans and credit cards, before falling behind on their mortgages. However, if the housing market remains sluggish, as it has been over the past 18 months, selling a home to alleviate financial stress can become more challenging. The current market conditions, characterized by more sellers than buyers, complicate the scenario further. Laberge points out that if homeowners are forced to sell in a tepid market, they might struggle to repay their mortgages, exacerbating their financial woes. Drew Donaldson, a mortgage broker at Donaldson Capital, notes that while regulatory changes might improve affordability, interest rates will be the pivotal factor influencing Canada's housing market in 2025. This sentiment is shared by many in the industry, who are closely watching how rate adjustments will impact the market. Another concern highlighted by Laberge is the potential impact of economic uncertainty, particularly with political changes in the United States. The return of Donald Trump to the U.S. presidency in January 2025 could introduce volatility to the Canadian economy, depending on policies that might affect trade and tariffs. On a more positive note, the Bank of Canada has been reducing interest rates since the summer, which could eventually ease mortgage costs for borrowers. However, Laberge cautions that the effects of these cuts might not be fully felt for another 18 to 24 months, delaying relief for those facing immediate financial pressure. Despite these challenges, Laberge remains optimistic about the resilience of Canadian households. Over the past 2.5 years, Canadians have shown remarkable adaptability, and there's hope that this resilience will continue as the housing market navigates these uncertain times. The Ontario Energy Board recently announced proposed amendments to the Distribution System Code aimed at facilitating housing developments across the province. These amendments are particularly significant as they extend the forecast period that electricity utilities use to estimate revenues from system expansions. This change is expected to reduce the payments developers need to contribute, thereby lowering costs for housing projects. Under the new proposal, the connection forecast horizon for developers can be extended up to 15 years, compared to the current 5 years, and the revenue forecast horizon will be increased from 25 to 40 years. These longer periods are designed to better reflect the long-term financial outlook of housing projects and reduce upfront costs for developers. Developers who have received, but not yet accepted, an offer to connect have the opportunity to request that utilities reevaluate their economic models using these extended forecast horizons. This could potentially result in more favorable financial conditions for their developments. It's recommended that developers formally reach out to their utility providers to take advantage of these changes. The proposed amendments are part of a broader initiative by the province to align the energy sector with its pro-growth agenda. This includes the introduction of the Affordable Energy Act, which aims to support large-scale energy expansion and reduce costs for new housing projects. The province has also announced plans for an integrated energy resource plan to improve the supply, production, and distribution of energy across Ontario. Key objectives of the Affordable Energy Act include prioritizing nuclear power generation, expanding energy efficiency programs, and facilitating the deployment of electric vehicle charging stations. These measures are intended to not only support new housing developments, but also enhance Ontario's overall energy infrastructure. The changes also empower the Minister of Energy and Electrification to unilaterally amend codes governing the distribution and transmission of electricity. While this shift reduces the independence of Ontario's electricity regulators, the government argues that it will expedite the process of connecting new homes to the grid, ultimately benefiting developers and consumers by reducing costs and improving efficiency. For developers and other stakeholders, these proposed amendments represent a significant shift in Ontario's approach to energy and housing development. Feedback on the proposed changes is being sought by the Ontario Energy Board, with the final amendments expected to come into force shortly after stakeholder consultations conclude. Economists are expressing confidence that the Bank of Canada will proceed with a rate cut in December, despite a modest rise in inflation observed in October. Statistics Canada reported that the Consumer Price Index increased by 2% on an annual basis, up from 1.6% in September. This rise in inflation remains within the central bank's target range, suggesting that it won't significantly impact the bank's decision to cut interest rates next month. Tiffany Wilding, managing director and economist at PIMCO, shared her insights with BNN Bloomberg, stating that the slight uptick in inflation does not disrupt the case for rate normalization. The outlook remains intact for the Bank of Canada to continue to reduce interest rates and bring policy back into more normal territory, Wilding said. However, she noted that the recent inflation data might reduce the likelihood of a larger 50 basis point cut. Wilding also pointed out that Canada's economic stability supports the case for rate normalization. She mentioned a strong retail sales report, indicating that the Canadian economy is not in distress. "We are in a period now where the Bank of Canada should continue to normalize policy," she added. RBC economist Abby Hsu highlighted that core inflation metrics, which are closely watched by the central bank, have slightly surprised on the upside, but remain within the acceptable range of 1 to 3%. These figures, along with an upcoming labor market report, will likely influence the Bank of Canada's decision on the rate cut at their meeting on December 11th. Hsu mentioned that their base case scenario anticipates an additional 50 basis point cut to the overnight rate by the Bank of Canada in December. This aligns with the central bank's efforts to support the economy while keeping inflation in check. Tuan Nguyen, an economist at RSM Canada, noted that the current state of excess supply in the economy allows the Bank of Canada to act without major inflationary risks. The acceleration in Canada's Consumer Price Index in October will not deter a December rate cut by the Bank of Canada, Nguyen stated, emphasizing that the precise size of the cut is still up for debate. Nguyen expects inflation to remain close to target levels in the coming months, providing the Bank of Canada with the flexibility needed to adjust rates appropriately. This sentiment reflects a broader confidence among economists that the central bank can balance economic support and inflation control effectively. Let's delve into the latest figures on housing starts in Greater Vernon and the broader British Columbia region. The Canada Mortgage and Housing Corporation, or CMHC, has reported a significant decline in housing construction in Greater Vernon for the month of October. The data shows there were 23 housing project starts, a noticeable decrease from the 38 starts recorded in October of the previous year. To break down the numbers further, the recent month saw the commencement of 9 single-family homes, 8 row houses, 4 semi-detached homes, and 2 apartment projects. Year-to-date, Greater Vernon has seen 160 housing starts in 2024, which is just over half of the 310 projects initiated during the same period in 2023. This decline reflects broader trends observed across British Columbia and Canada. Shifting our focus to Kelowna, there were 52 housing starts in October, which, similar to Vernon, marked a decrease from the previous year. However, Kelowna has experienced an overall increase in housing starts throughout 2024, recording 3,719 starts so far, surpassing last year's figures. Unfortunately, specific monthly and year-to-date totals for Kelowna were not detailed in the report. Looking at the province-wide data, British Columbia recorded 3,350 housing starts in October, contributing to the 19,670 starts nationwide. This is a decline compared to October 2023, when BC had 4,788 starts, and Canada had 22,163 starts. To date, BC has seen 35,603 starts, while Canada has recorded 188,112 starts, both of which are down from 2023's numbers at this point in time. Despite this decline, British Columbia still ranks 4th among Canadian provinces in terms of housing starts for October, trailing Ontario, Alberta, and Quebec. Notably, Alberta and Quebec have seen month-over-month increases in housing starts, whereas Ontario's figures have declined. These fluctuations highlight the varying dynamics and challenges faced by different regions in the current economic climate. These statistics underscore the ongoing challenges in the housing market, influenced by factors such as economic conditions, interest rates, and regulatory changes. As we continue to monitor these developments, it's crucial for stakeholders in the housing sector to adapt and strategize accordingly to navigate these shifting trends.